Well, greetings, everybody. I'm very delighted to have as my guest on again, Nick Ward. In fact, we're sort of a dual we're sort of a dual game at the moment. You could argue strategy and tactics. You could argue all sorts of things. I've had some lovely messages from subscribers, and one particularly interesting one I got from America a little while ago, which said it's always good to see Nick Ward and Godfrey Bloom. They're the sort of Fortnum and Mason of the gold space, which I thought was rather nice. Especially, he could have said that we were something else. But never mind. So he didn't say Batman and Robin, which would have embarrassed us. But there we are. Now today, we're not going to talk about derivatives particularly. We're not going to talk about anything else other than the main elephant in the room at the moment is banks. And my subscribers will probably have my tatty book by now after 10 years. And I said that, how banking works, what the drawbacks of the banking system that we have, and some of the problems that we're going to face ahead. And this was 10 years ago, and they're coming down the road now. So Nick's going to talk all about those. He's on very much the sharp end, and he sees things very clearly from the sharp end. So he's going to tell us the whys and wherefores of banks, and also after that he'll come on to what we can do. What we can do. Yeah, the banks are dodgy. The banks are dodgy. What can you do? There's all right. I was saying it's easy to say the banks are dodgy without actually giving you any advice on what you can do. So I'm going to leave all that to him now because he's very much in the swim of it. So Nick, welcome again. Welcome again. Thanks for coming on and tell us your take on banking and debt and the way things are going and how you feel about it and what's it like on the sharp end.
Yeah, thanks very much for having me on again, Godfrey. And at the moment, people are asking me every day, is there going to be another banking crisis? So people look at 2008, the savings and the loan crisis of the 1990s, as well as the collapse of Silicon Valley Bank, of course, back in 2023. And they just want to know, when's the next one coming? Well, look, it's already here, but it's happening in slow motion right before our eyes. But most people can't see it because they're looking for the wrong signals. They're expecting another Lehman Brothers moment where it happens suddenly over the weekend. But this time, the crisis is structural, Godfrey. It's systemic, and it may play out over the next few years instead of just in a couple of days or weeks. Either way, it's inevitable. It's just a matter of time frame. So there are 4 critical warning signs which show we're heading for a fundamental breakdown in the banks. And these simply can't be plastered over with new regulations or playing around with interest rates. These are existential threats, Godfrey, to the traditional banking model. And that's what's going to separate the survivors from the casualties here. And if you're not prepared for what's coming, you could lose everything that you've worked for. If you just leave it all in the bank, it could all be gone. Now, the first warning sign, really, which should terrify anyone who understands how the banking system works, like yourself, Godfrey, is leveraged ratios. And look, for anyone who doesn't know what that is in the audience, that's just basically a reliance on debt to fund your operations. That's all it means. It's a fancy word. But these have become completely they're unsustainable in the market. They can't carry on like this. And it's not just bank leverage, it's leverage everywhere in the system. Corporate leverage, household leverage, government leverage. But if we start with the banks, let's just use the major banks in the US for an example at the moment, the major tier 1 banks, their leverage ratio is about 9%. So that means for every dollar they have, they're lending out about 12. And that might sound conservative, Godfrey, when compared with the investment banks, of course, in 2007, which were leveraged, I think it was up to about 30 to 1. But it's not conservative at all when you consider the quality of the assets and the stability of the funding. So what most people don't understand is those leverage ratios, they don't tell the whole story. you have to look at what the banks are actually lending against and how they're funding those loans. And you've mentioned this a couple of times in the last 6 months, Godfrey, but the banks are holding huge amounts of commercial real estate. And commercial real estate, of course, is facing the worst crisis we've seen since the 1980s. Office buildings are empty because of remote working, retail's empty because of e-commerce. Hotels and restaurants, of course, are still feeling the effects of COVID, etc. So the mid-sized banks are sitting on hundreds of billions of dollars worth of loans that are going to default in the next couple of years. And when those hit, their capital ratios are going to collapse. I think the number is, Godfrey, and correct me if I'm wrong, is it? I think there's $1.5 trillion now of commercial loans that are maturing in 2006 and 2007. And those won't be able to be refinanced because property values have crashed and interest rates may still be going up, despite obviously the new Fed chair that we have. So we're in trouble when it comes to commercial real estate. We really are. And look, it's not just real estate either, Godfrey. They're sitting on huge unrealized losses in the bond market, of course. After the Fed raised interest rates from 0% to just over 5% in about 18 months, when that happened, the value of long-term bonds collapsed. And of course, we did a podcast about this, didn't we? We saw Silicon Valley fail because they had to realize those losses. Every depositor demanded their money back. And of course, it was an old-fashioned bank run. But every other bank still has the same problem, Godfrey. This is the issue. They just haven't been forced yet to realize those losses. And what keeps me awake at night, amongst other things, is that if interest rates stay elevated, or even if they go ever so slightly higher, banks across the system are going to be forced to recognize these bond losses. Now, combine that with the commercial real estate and all the defaults that we're going to see there, you're looking at a capital crisis that makes 2008 look like a walk in the park.
Actually, just popping in on that one, because you're absolutely right, Nick. What you're actually looking at is bonds, which were government bonds, United States government bonds in Silicon Valley Bank, which were designated a tier one asset. They were a tier one asset. And of course, you're in a situation which, when I was lecturing years ago, commercially, not academically, commercially, that when interest rates tick up, the value of existing bonds collapses down, and it depends on the ratio. A lot of actually people don't always understand that that last year's bond is yielding less, so it's going to go down, and that's the other thing. And of course, the other fantastic thing, all coming at the same time, which is quite extraordinary, is commercial real estate, which is central New York or wherever it happens to be, which normally would be regarded as AAA. So here we have a tier one asset joined with a massive AAA asset, which is prime real estate, commercial real estate, all collapsing at the same time. There can only be one answer, and the banks must collapse, or you have quantitative easing to bail them out at such a level that it degrades money and it's inflationary to an extraordinary extent. And I have to just put my hands up here a bit. I have been wrong on timing. I have said all this is going to happen as sure as God made little green apples. It's going to happen. I've been wrong. I thought it was going to happen 2 years ago, and it's still creaking along. But, timing is everything. But sorry to interrupt. Do carry on.
No, absolutely. No, you hit the nail on the head there. It's not exclusive either to the banks, Godfrey. Corporate America is sitting on record amounts of debt. A lot of that's at floating levels. So when they increase interest rates, of course, it's a problem for them. Household debt is at record levels. Consumers are stretched with inflation, higher borrowing costs. And government debt, of course, we've spoken about this far too many times. So that's just at a level now which is totally unsustainable. It can't carry on. So look, all this leverage, it used to be fine. It was fine when interest rates were low and asset prices were rising. But now the rates are elevated and assets are under pressure. The entire leverage system is starting to collapse. And when it breaks, it's going to take the banking system down with it. There's no doubt about it. But the second point, as I know I've mentioned 4 points, the second warning is interest rate risk, which most people don't even realize. They wouldn't even comprehend it because it's just hidden in plain sight. So, look, the banks, Godfrey, they make their money by borrowing short term and lending long term. So they pay their depositors 2% in the bank, and then they charge their borrowers 6 to 7% on their mortgage, and the difference is their profit margin. And that model works. It works wonderfully when interest rates are stable or declining. But it becomes a death trap when rates rise rapidly, which is exactly what we've seen in the last few years. So banks that made long-term loans at, say 3% when rates were low are now having to compete for deposits at 4%. So they're losing money on every single loan that they made a couple of years ago. And I think, look, Silicon Valley was just the canary in the coal mine there. And it absolutely loaded up on those government bonds at near zero, thinking they were being cautious. Rates spiked. Yes, like you said, Godfrey, the value of those bonds dipped by about 20 to 30% of their value. And all the depositors got nervous, classic bank run. SBP was forced to sell those bonds at a massive loss, and they went under. But what's terrifying as well, Godfrey, is Silicon Valley. They weren't just the outlier either. They are typical, absolutely typical of hundreds of banks in America. They've got the same interest rate mismatch, if you like, with long-term assets yielding 2% and short-term liabilities costing 5%. So the maths don't work. And what makes this more dangerous is look, I don't know, but with the appointment of this new chair, have they finished raising rates yet? I mean, he's meant to be a hawk. At the same time, he's in Trump's pocket. I don't know. But inflation's still pretty persistent. The labor market's tight. Fiscal policy is still pretty stimulative. So despite the new appointee, it's definitely going to take, I think, higher interest rates to get inflation under control. I don't know what your opinion on that is, Godfrey.
Yes, I think I think the problem that we have, you're absolutely right. The problem is in North America, and certainly in the United States and in Britain, we have a rather odd situation. There's no political dynamic which is pushing back against government spending. So we have no elections ever, to my knowledge, certainly back to the 80s, where anybody is standing for Parliament in this country, or whether it be the Senate or Congress in America, saying, we have to stop this ridiculous amount of government spending. We have to do it to any great extent. Lip service is paid, but it's not really, it has to be drastic. It has to be drastic. So we're going to have the same problem, of course, with the British banks, which hold very high level of gilt, just the same situation. Interest rates eventually will have to go up to cover prolific spending by this government, and this government's particularly bad, and the last one wasn't very much better. And of course, you'll see a collapse in the capital value of gilts. And of course, most banks and insurance companies, don't let's forget insurance companies, who have been regulated into holding rather more gilts, perhaps, or government debt than they otherwise would. So this is going to be right across the board. I saw it being, there's very few advantages of being an old geezer, believe me. But I've lived all through this in the 70s. I've seen it all before. And it's going to happen again. The difference is it's going to happen big time. It's going to happen in spades. And it's not going to it won't be solved by getting rid of Jim Gallagher or Harold Wilson's ridiculous governments when they didn't know what from clay. This lot don't either, but they are now in so deep. I don't know. I'd sometimes think I don't know how we're going to come out of it at all. I can't see us coming out of it at the ballot box.
So it doesn't make any difference who gets in at all. You actually mentioned regulation there. But that was going to be one of my last points, but I'll touch upon it now because I think that flows quite nicely. But regulatory pressure is pushing the banks to breaking point. So ever since 2008, regulators have been adding more requirements onto banks. So higher capital and liquidity requirements, stress testing, anti-money laundering. The list just never ends. It's crazy. Yes, look, some regulation, of course, is absolutely necessary to prevent those excesses that we saw in 2008. But what we're seeing now has gone far beyond reasonable oversight. We've got complete overkill, Godfrey, which is making it impossible for the banks to operate. I don't know whether you've looked at it, Goddard, but the Volcker rule in the US, I think it's 900 pages long.
Yes, it's
And,
quite a tone.
yeah,
And
it
that's the last
requires.
time, that is the last time any government really gripped it.
Mm, but there are thousands of different metrics now that the banks have to operate with, and as a result, they're hiring legions of compliance officers to navigate it, and they can't even provide now some of the basic market making functions that were once the standard of those banks. So they are just putting them in a straitjacket. They've also got a go on.
Just then, the point that gets me a bit annoyed about all these things are, of course, when you have more regulation, it sucks out any acknowledgement of caveat emptor from your investor or your depositor. They think, I don't have to worry because it's got the FSA stamp on the bottom, or the FC, whatever it is, stamp on the bottom. Somebody's done the homework for me. But you've got to understand that the people who've done the homework are part of the same problem. Your regulator and your compliance officer are part of the problem. It's a little bit, if I may use this analogy, and I've used it before, excuse me for using it again. People don't drive very safely, and I've just driven down here to the south, to the south from Yorkshire. People are driving like maniacs on rainy motorways because they have seatbelts, airbags, and sat nav and all those things, so they're cocooned. I've always said you'll drive a lot more safely if you weren't allowed a seatbelt and you had a rusty spike pointing at your chest in the middle of the steering wheel. There'd be no tailgating, there'd be no overtaking on the inside, there'd be no maniacal driving. Everybody will be very careful, because you won't persuade anybody of that. True, though, we all know it to be.
Exactly that. Yeah. People have no idea now about risk because they're always going to get bailed out. But look, the banks supposedly, look, we all know the figures are rigged, but they've also got to hold a certain amount of capital, which you briefly alluded to as well earlier, Godfrey, to withstand a recession. Regardless, look, the numbers are cooked. That's by and by here. But could that capital otherwise be used to create loans for more productive means in the real economy? So long and short of it is compliance costs are now running into the billions annually. And they just seem to keep going up and up and in one direction, which is hitting the smaller banks and the building societies even harder as they can't scale. They can't absorb these costs. So regulation, it's driving the banks out of business. And I think the statistic is since 2008, Godfrey, this is in America, but 2,000 banks have gone out of business, mostly due to regulatory burden, which is, I think it's a 25% decline in banks. Now, what's really interesting is this results in the banking system becoming increasingly more concentrated in the hands of a couple of institutions. And the problem with that concentration is it creates even more systemic risk. So when there are fewer players, each player becomes more systemically important. And when one of them has problems, it affects the entire system even more. So again, coming back to what you said there, Godfrey, it's ironic. Regulation is not making the system any safer. It's making it a lot more fragile, more concentrated, and more vulnerable to these systemic shocks. So they're regulating banks to death in the name of safety, but they're actually creating the conditions for the next crisis.
I was as you know, I was 5 years on the Economic and Monetary Affairs Committee in the European Parliament. There are usually about 40 people on each committee. You know, there's a committee for everything, but I was on the Monetary Affairs Committee, and it was fascinating. The people actually mooting, if you will, the regulations come from the Commission, who are civil servants, who don't know anything about banking or finance at all. Their background is usually in France, the place is academic, and it's true certainly of the Treasury. They read classics, all very nice too, and they're jolly nice chaps. And then it came down to the amending chamber in the Parliament, because all this originated from the EU when it comes to West European banking regulation. That's where it all sort of spun out. It was actually fascinating because they were then your amending chamber to this nonsense. You know, I'll be reading through the new regulations and all that. It largely was going to be based in Paris until we got out. The City of London, who are all in favour of being members of the European Union, didn't realise coming down the road they were going to be regulated by Paris, and largely a French bureaucracy, which they didn't know because they were a bit stupid in the city. I know who used to work there. But if you look round your committee, your 40 people, you've got Danish housewives, you've got Bulgarian socialists, you've got French trade unionists, all sitting there, second guessing regulation. And every now and again, I was called upon by the chairwoman to actually explain what it was. I remember vividly explaining what an investment trust was because they don't have them on the continent. So I had 10 minutes trying to explain what it was while they investigate the regulation of it. It's amateur night. It's amateur night at the commission. It's amateur night in the city. It's amateur night in politics. I mean, have a look at our Chancellor of the Exchequer if you don't believe me.
Oh, dear. They don't even understand the basics, the very basics. Just comprehension, let alone what's going to happen in the future. They've got no idea of trying to plan ahead. And that, I suppose, links to the final point that I was going to make about the banks, which I think is actually probably the most dangerous, which is technological disruption, undermining their fundamental business models. Because, look, for centuries, the banks have had a monopoly on moving money, storing money, lending money. That monopoly is ending. And most traditional banks, they're not prepared for what's coming, Godders. So, look, fintech companies are attacking every aspect of banking. You've got your Wises, your PayPals, Revoluts. They're making a lot of the branches obsolete. You've got these new lending platforms you might have seen, like Funding Circle and Lend Invest. They're using these algorithms to make credit decisions a hell of a lot faster and quicker than your traditional bank branch could do. Robo advisors are taking over from traditional investment services and wealth management. And then, of course, I'll just touch upon this, but crypto and blockchain. Bitcoin allows people to store value without any involvement from the banks. Decentralized finance allows people to lend and borrow directly and to cut out the traditional intermediary, which is the middleman there, which is the banks. And then to top it all off, we've got CBDCs as well, which are being developed by every country in the world. And that could eliminate the need for commercial banks entirely, Godfrey, because if the Bank of England could just issue a digital pound, why would consumers ever need to go and open up a current account in their local branch? I think the Bank of England, could they do it a lot more efficiently than the banks? I don't think so. But that is a threat. I think we're a few years out from that. Everyone thinks it's going to happen tomorrow. No, it's not. They're still developing it. And I think we might be a good 3, 4, 5 years away from that. But I think at the moment, in the short term, when it comes to banking collapse and their business model, what they've really got to address, the biggest threat from technology, that is companies like Apple, Google, Amazon, Facebook. They have billions of customers and they've got really, really sophisticated technology platforms, as well as an unlimited war chest. They've got all the capital in the world. And they are now moving into financial services. And they're just getting started, Godfrey. So it's going to come to a point where all your banking is done through Apple's payment system with Apple credit products. And Apple already knows more about your spending habits than any bank does. They've got better technology, nice smart interfaces, all the data in the world. Why would you continue to use a traditional bank? So the smaller banks, they do not stand a chance. They're going to get wiped out. I think that's inevitable now. They haven't got the resources to invest. They're losing customers every single day. But I think most of the banks are so stuck with their head in the sand. They can't see the wood through the trees. They think this is just another business threat. They can't see that it's actually just going to wipe them out. And they're not making the transition fast enough. They really aren't. So look, if you take all of these 4 signals together, they are creating the perfect storm for destroying the banking system. And each of these problems, look, you've lived through so many of these problems, Godfrey. You know that each of them are manageable individually. Banks have survived leverage before. They've navigated interest rate cycles. They've adapted to new regulation. They've also competed with new technology. But dealing with all 4 of them simultaneously is a different challenge entirely. So to put it bluntly, look, high leverage makes them more susceptible to shock. Rising interest rates are creating those shocks by destroying asset values and increasing funding costs. And regulatory pressure is preventing the banks from taking action to address those shocks. And then at the same time, technological disruption is eating away at their revenue base and making it harder for them to earn their way out of trouble. So it's this vicious cycle. The banks become weaker, regulators impose more restrictions, these become more burdensome, the banks become less competitive, alternatives gain their market share, and then the banks lose even more revenue, making them even weaker. And then they become more vulnerable because they're weaker to interest rate and credit risk. So the result is you end up with this banking system that's over-regulated. It's totally undercapitalized, and technologically, it's totally obsolete. So look, how's this collapse going to look? It may happen suddenly, it may happen immediately, or it may be a slow grind. And I think the answer is it's going to be a train wreck either way. Of course it is. But the survivors from this are going to be a handful of large institutions, and most traditional banks and building societies are going to go under. It's going to be brutal on so many of their customers, as well as their bank employees. And what I'm saying to people at the moment, Godfrey, is don't wait until the bank fails to protect yourself. You have to be prepared, because most people are sleepwalking into this. The banking system by 2030 is going to look a lot different than the one today. I mean, we're looking 4 to 5 years out. And most banks, I don't think, are even going to be around to see it, Godfrey. They're really not.
I think the other thing that people aren't fully familiar with, and I'm sure you'll agree with this one, is they don't quite know where they are in the pecking order if the bank goes down. And they have a deposit. They are well down the pecking order. It's your, it's your preference shareholders are above, the HMRC is above, so on and so forth. If you're a bank depositor, you're well down. And I don't know what the value of financial insurance, sort of government sponsors is going to be. They're going to pay you in shirt buttons, aren't they? So yeah, so none of this can work. So yeah, there's no point in waiting for it to happen. And I got I got an email only this morning from a lady who said she's got ISA, she's got a deposit account. They're in more than one bank. She sounds to me like a lady who is pretty wick. She knows what she's doing. She's also said, but I don't trust the banks. Have I missed? I'm sorry to sort of run you into this one, but she said, have I missed the boat on gold? Because that seems to me to be the solution. And I explained to her that gold isn't going up, fiat currency is going down. Do you want to just expand a little on that? Because very few people, unless they are old subscribers of both our networks, they won't necessarily understand that.
Yeah, it's reframing the narrative there and your mindset towards it and seeing it as money instead of currency. Because what are you going to do if you cash out of your gold? Just put it back into fake fiat currency that's inflating away. That is the case. There's a very finite amount of gold. There's no limit as to the amount of money they can print. So you have to see it as a store of wealth rather than a get-rich-quick scheme where you're just cashing in and out of it for more fiat. It completely defeats the object of owning precious metals, Godfrey, which is to protect you from this banking collapse, is to get your money into something that's a store of wealth. It's always going to protect you. It's private and there's no counterparty risk. No matter what happens, that is under your mattress or it's in your vault. No one can take it away from you. And when these banks go under, it's going to cause, 2008 really is going to look like a walk in the park. It is. And there's no limit as to the amount of money that comes out. Private credit, this is another thing that's really worrying me, because if you're going to throw fuel on the banking fire here, Goddess, no one's talking about the amount that has been lent out in private credit, which is really, really serious. So the most dangerous crises are the ones that no one is watching. So if I talk to you about subprime mortgages in 2007, people would look at me weirdly, or you weirdly, and they think, "What the hell are you on about?" So private credit, basically, I'll get on to the point. It's loans made by non-banks, like hedge funds and asset managers and private equity funds. So this is this is a 1 trillion market where there is no transparency, there's no oversight, there is no public reporting. No one has a clue what these loans are or who has them. So to link back to your point there, no one has any idea quite how much fiat currency is out there, Godfrey. But because all of this private credit is created by hedge funds, well, look, where do the hedge funds get their money from? They get them from the banks. And as we've already covered, regulation means it's very, very difficult for the banks to lend out. But if they give that money to a hedge fund who lends it out to down and out Dave down the road with 5 credit cards, well, the bank doesn't have that exposure then. The hedge fund does. And this is already starting to raise its head in America, where we've seen a couple of companies go under. I think you might have spoken about this, Godfrey. But
yes,
was it Tricolor Holdings and First Brands Group?
There's been 1 or 2, and of course, in the back, shadowing around in the back, of course, is BlackRock, who don't like talking about the fact they've lost money.
Yes, I'll come on to, but that is the elephant in the room. And obviously the largest asset manager on earth who manage trillions, well, their TCP Capital Fund, which is a private credit vehicle, that lost 19% of its assets in the last quarter. And they are the most sophisticated asset manager in history. So that is a little bit of a warning sign. That's really, really worrying. And of course, private credit is tied to the banking system through derivatives, credit default swaps. Of course, we saw in 2008, Godfrey, IAG, I think it was 180 billion. I think that was the right figure. That was a bailout because of their derivatives. So when this blows on top of all that structural risk that we've already spoken about, that means the banking system is going to need another bailout. But what I think is more likely is a bail-in, where the government take money from depositors, from anyone with more than 100,000 euros or 120,000 pounds. They'll take 50% of it, 100% of it. Who knows what figure they're going to pluck out of thin air. But money that you thought is safe, well, it's not at all. And they've got the legal framework for taking all of it. And of course, the other thing to think about here are too, God, I don't want to bore you to death, but under certain circumstances, the FSCS can convert your savings into equity. So they'll just convert them into stock. And God knows when you'll be able to get that out. So there's a lot of different dynamics going on here. But another question I'm also asked a lot, so many people are saying this to me on the phone, is, well, what do I look out for a banking collapse? What's going to happen? Most people think when a bank fails, it fails immediately. But actually, that's probably the last step. Because before the public announcement, there's a phase where regulators secretly take over control to prevent any mass panic. They don't want everybody jumping out and getting on the life raft at the same time. The FSCS over in America, or I think it's within the FCA's remit here, they can replace the management, they can restrict dividends, they can control the bank behind the scenes while it still looks open for business. Which is quite worrying. And we saw this in the savings and loan crisis, saw it in 2008. Is it happening again right now? How do you spot a bank even, Godfrey, in receivership? You've got to look for all those red flags that the insiders use, like those sudden dividend cuts, getting rid of directors and CEOs without any future planning. Look, we've already seen Metropolitan Capital Bank and Trust. They've collapsed this year already. You've got 2 others. I think it's Western Alliance Bank and Zions Bank. They've got loads of exposure to fraudulent loans. We've also got Capital One and Citigroup. They're facing massive regulatory pressure due to these changes that we've mentioned. So is this the start of it? Well, it could very well be. And I think people just need to be aware of that. And they need to think, don't keep any more of your money in the bank than you need to. Get some of it into gold. Go on.
if you're
Sorry, go on.
if you're watching this, my subscribers, I think I covered it in my book and I covered it in my website, I think, but I can't quite remember. That's an age thing, if you like. But you'll find it in microcosm in Cyprus. When the
Yeah.
Cypriot banks went down, it was a bail-in, and it depends what part of the ledger you were in. And I remember one particular guy, because I was in office at the time, who was a retired army officer who'd set up his own brewery, and that was down as commercial and not personal. And he lost his life savings that he'd put into this little brewing company. Every one of these things, and do pay attention, everybody, to this. Every one of these things carries a heartbreaking personal story. It's not just numbers, and it's not just macro and all this kind of stuff. You know, behind every one, there's a tragic story, and sometimes even a suicide. It's really when it goes down, when it happens. You know, don't be that subscriber. Don't be that subscriber to our channels, either, you know, Nick or me or whatever it is, whoever it is you like to follow. Don't be one of those. Anticipate it. Now is a time. Now is a time. Don't put it off. Don't say, "Oh, I'll do it when I get back from leave, or get back from holiday, or you know, I'll do it next month, or do it." You know, don't hesitate. Get started now, because I think, Nick, you'll agree with me. Although these things can have a habit of happening very slowly, then suddenly it all happens at once.
Exactly. Don't wait for the press release, because it's already too late.
If you read it, the old style, me and some of the old colleagues that we both have, you know, like Alistair MacLeod and people like that, when you've read it in the Evening Standard, it's too late.
Exactly. Far too late. So get your excess cash into the metal now. And a lot of the banks are putting hurdle after hurdle after hurdle in the way. Even if people looking to buy 10 grand's worth, Godfrey, they do not want you taking it out because they know that they don't have it. And if you look at the deposit protection scheme, this is actually public data as well, Godfrey. If you look at the amount that we've got in the UK banks as to how much is insured, I ran the numbers and it actually looks like 0.026% of it. So to put that into proportion, for every £100,000 you've got sat in the bank, you're only covered for 26 quid. So if things really hit the fan, that's how much you've got left.
And we both get unpleasant stories, don't we, Nick? Both of us get unpleasant stories from people who've been into the bank. And they will not give you their money if you want to buy gold or even a motorbike or a car. They will not give you, because there's some of them are on bonuses, not to let you have what you imagine is your own money back. And if you're elderly, if you're an old geezer like me, I know how many bees make five. But one unfortunate subscriber of mine was in his 80s, and he said, I went in, they wouldn't let me have my money, they wouldn't let me buy any gold, and I asked to see the manager, and the manager wouldn't even come downstairs to see me. And he sent me a note, and he said, I've given up, Godfrey, I've given up. I'm 82, and I just can't cope with it. Bastards, these bastards. You know, I mean, the guys, he's an old guy. He was fully on the ball. They wouldn't give the money for him to settle what he wanted to do at that time of life. You've got to understand, if you're watching this, these people are bastards.
Godfrey, I had one lady she went down to the bank about 7 times in the last 6 months, and they wouldn't let her do it, wouldn't let her do it. Gold price has gone up in double digits. She was down hundreds of thousands of pounds in fiat. Make of that what you will. I had another client that went in there with his wife and his mother-in-law at a very top 4 bank in the UK, and they took them round to the back office. Bank manager told them to sit there. 30 minutes went by, still nothing. Another half an hour goes by. All of a sudden, the police turn up outside the door because what they think that they're trying to push their elderly mother into doing something that she doesn't want to do, and they're con men. Didn't tell them at all, just literally called up the police, who arrived outside the front door. You could not make it up. That's just 2 of a myriad of different stories that I've got, but they will find any excuse by crook or by hook to stop you taking your money out. Imagine how bad it's going to be in 6 months. Imagine how bad it will be in 12 months.
It's going to get worse.
There's a limited opportunity. There's a limited window of opportunity. There really is.
Tell them you're recording it. Go in and tell them, click on your machine or your phone or whatever it is, says, I'm recording this.
Yeah.
Because I don't believe you've got the money to give me back. I think you're all a bunch
No.
of scoundrels. I'll go through. I know you have to give. And I just did this the other day because you remember before Christmas, because I did it with your partnership. I did a big transaction because I'd sold a house. And so I was actually doing that. And I went into my bank and just clear this up. I warned them I was coming in. I went in to say, I'm coming in. I want to do this. I know you have to tick the boxes for, these compliance. I understand that. And I know you're going to do that. I know it's going to take half an hour. I'm coming. It's a joint account. I'm coming with my wife. And they went through question after question. And I answered every question. And I said, not everybody can do this. I held up my own book on banking. And I said, and by the by, I know more about banking than you will ever know. Here's my book. And I'm leaving you with my book because I know you've done a fortnight's course and I've devoted my life to this subject, right? Okay, so that's the difference between us. And you can bring in your boss and your boss's boss, and I'll know more about banking than he does as well.
But the cashiers are just being told to do this, though, Godfrey.
I feel sorry
It's not even their fault. I do. They are, and they're getting this from up above. And a lot of the bank managers have no idea what's going on for the reasons that we've already covered so far on this video. But yeah, if you want to get around it, you have to take the names of everyone that you're speaking to. You have to timestamp it, record it, and if they don't do it, you can make an official complaint. That will usually get you what you want. But it's just a question of standing up and shouting louder and making sure that you don't buckle, because they know the game's up. And they are just trying to delay the inevitable, but using your savings to do it. So get it out, get it into some gold, storage or delivery. You then have complete ownership of it, and there's no counterparty risk. No one's telling you what to do with it.
Good advice. Anything else we could tell anybody before we sign off?
No, Godfrey, if anyone wants to give us a call, of course, they've got the link underneath on your video. They can come through, have a consultation with one of us here, or they can come straight through to me. I'll give them as much time of the day as they need. Any particular questions, nothing's too stupid. You'll see a link below there with our number on and our email address. Please do get in contact, and I'll be happy to speak to anyone that wants to get it out.
Great. By the way, just to reinforce, I think everybody, my subscribers know, when I'm getting new subscribers all the time, I'm not a dealer. I don't deal in gold. It's of no concern to me to whom you go for your gold. It's nothing to do with me. I personally buy my gold from Nick. But that's a historical thing. We've been kicking around now for something like 7 years, I think, quite extraordinary, affiliated in some way. And another thing which is worth knowing, because Nick obviously is a busy fellow, Nick's team, I know all of Nick's team as well. And I was, Nick was away, but I was actually boozing with them in London only last week, a couple of weeks ago, at my club. And I make sure that they're all jolly nice fellows. And if can't get Nick, or Dan Alderman, his partner, very good manager, but you will find somebody there who's very nice. And if you're on my website, if there's somebody on my website, if there's a dealer on my website, they will also be very reliable people, otherwise they wouldn't be there. I just happen to use GBP myself because you get a little bit more experience. You go to them instead of just a dealer, but it's up to you. But look at my website. As I say, I go to Nick. That's my opinion, but there we are. You must do what you think is best for you.
Thank you very much, Godfrey.
Okay, everybody. Thank you so much. Thanks
catch you later.
Thanks. Bye-bye.
Bye.
As most of you know, my work is very heavily independently research-based, and I get my information from all over the world. It would help if you press the subscribe button and the little bell next to it, because the more subscribers I have, the more likely it is that international independent research institutes will share their material with me. It's most helpful, and then of course I automatically share it with you. So surprise, won't cost you anything. Thank you very much.